Welcome to the English listening practice. Today, we have an amazing story for you. It's about a man who became one of the richest people in history. His name is Warren Buffett.
But this isn't just a story about money. It's about how a boy from a small city built a huge fortune using simple ideas. We'll talk about his first investments, his smart business deals, and his very unusual life. This story is fascinating, and you'll learn a lot of great English vocabulary and phrases. So make sure you listen to the very end.
Every year, thousands of people travel to Omaha, Nebraska. They don't go for a concert or a sports game. They go to a shareholder meeting. They fill a huge arena to listen to a man in his 90s. He sits on a simple stage, often with a cherry Coke and some peanut brittle. For hours, he answers questions from the crowd. He doesn't use complicated words or confusing charts. He speaks simply and clearly, using stories and common sense. He explains big ideas about business and money. And for those hours, the world of business listens carefully to every word he says.
The man is Warren Buffett. He is the chairman and CEO of Berkshire Hathaway. He turned a failing textile company into one of the biggest companies in the world. People call him the Oracle of Omaha. But what's the real mystery that brings people here every year? How did this man from a quiet city become so incredibly rich? He still lives in the same simple house he bought in 1958 for about $31,000. He starts his day with a McDonald's breakfast that costs less than $3.17. How did he build his fortune, not with technology or oil, but by simply investing?
The answer is in a metaphor he uses to describe his life. This metaphor became the title of his biography, The Snowball. Buffett once said, "Life is like a snowball. The important thing is finding wet snow and a really long hill." This is the story of how he found that wet snow in America after the Great Depression. It's the story of how he found the longest hill, the power of the American economy. And it's the story of how he carefully and patiently rolled that snowball for almost a century. The snowball gathered more snow and speed until it became an avalanche of wealth. This is a story about compounding, not just of money, but of knowledge and wisdom. This is the story of the snowball.
Warren Edward Buffett was born on August 30th, 1930, in Omaha, Nebraska. His timing was very interesting. He was born just after the 1929 stock market crash. That crash started the Great Depression. He grew up in a time of economic fear and worry. For many people, it was a time of having very little money. This environment where financial security was so important shaped his whole life. He was the middle of 3 children and the only son of Howard and Layla Buffett.
His childhood was shaped by 2 very different forces. His father, Howard, was a stockbroker. Even in hard times, Howard built a successful business selling safe investments. Howard was a man with strong principles and honesty. He was later elected to the U.S. Congress. He taught his son about finance and took 10-year-old Warren to the New York Stock Exchange. Most importantly, he gave his son unlimited confidence. His mother, Layla, was very different. According to books, she had unpredictable emotions and could get very angry. For a sensitive young boy, home often felt chaotic.
These 2 forces shaped the young boy. The chaos at home pushed him toward a world he could control. This was a world of numbers, logic, and clear results. His father gave him a strong moral compass to guide him. This combination became the engine for his ambition. To escape the emotional problems at home, Warren found comfort in the clean world of numbers. He became obsessed with statistics. He and a friend would sit and write down the license plates of passing cars, looking for patterns. He spent weekends at his father's office, happily writing stock prices on a big board. Numbers were his friends. They followed rules and were always predictable.
His love for numbers quickly turned into a love for making money. When he was 7, he read a book called 1,000 Ways to Make $1,000. The book was a big inspiration for him. It was about creating systems to make money, not just getting a job. His entrepreneurial drive exploded. He started by selling packs of chewing gum door to door. He was already thinking like a businessman. He wouldn't sell single sticks of gum because he might have leftover pieces. He also bought 6 packs of Coca-Cola for 25 cents and sold each bottle for 5 cents, making a 5-cent profit.
When his family moved to Washington, D.C., his businesses got bigger. He got a paper route delivering the Washington Post. He treated his paper route like a real business. He planned his routes to be very efficient. By age 15, he was earning $175 a month, which was more than his teachers. When he was 14, he filed his first income tax return. In a famous move, he deducted his bicycle and his watch as $35 of business expenses. His ambition wasn't just about earning money. It was about making his money work for him. At 14, he used $1,200 of his savings to buy a 40-acre farm. He then hired a farmer to work the land, creating a source of passive income. He was already starting to build his snowball.
For a boy who loved numbers and money, the stock market was fascinating. At age 11, he told a friend he would be a millionaire by the time he was 35. He said if he wasn't, he would jump off the tallest building in Omaha. It was a dramatic promise, but he took action. He took his savings of about $120 and made his first stock purchase. He bought 3 shares of a company called City Service for himself. And in his first act as a money manager, he bought 3 shares for his older sister, Doris. Each share cost $38.25.
What happened next was a tough lesson about the emotions of investing. Right after he bought the stock, its price started to fall. It dropped all the way down to $27 a share. The 11-year-old Buffett was in agony. It wasn't just his money. It was his sister's money. Every day, his sister Doris would remind him, "My stock is going down." He felt terribly responsible. It was his first real experience with the stress of managing other people's money.
He held on nervously. Then, the stock started to recover. When it reached $40 a share, he felt huge relief. He sold all the shares, making a small profit of about $5. He had survived his first market test. But his relief quickly turned into a different kind of pain. Soon after he sold, the City Service stock started to climb much higher. It didn't stop until it passed $200 a share. The small $5 profit could have been almost $500. It was a mistake he would never forget. This single event taught him 3 lessons that became the foundation of his philosophy. First, don't worry too much about the price you paid for a stock. Second, don't be in a hurry to sell for a small profit. Patience is key. And third, he learned about the emotional stress of investing for others.
Another early business taught him about the magic of compound interest. In 1945, he and a friend bought a used pinball machine for $25. It wasn't just a toy, it was a small cash-making machine. They made a deal with a local barber. They put the machine in his shop and split the profits 50-50ths. The machine was a success right away. After the first day, they found $14 in the coin box. Most teenagers would have spent the money, but Buffett saw the profits as investment money. As soon as they had enough, they bought another pinball machine, then another.
In a few months, their single $25 machine had become a small empire. They had several machines in different barbershops across Omaha. They even gave their business a professional name, the Wilson Coin-Operated Machine Company. Buffett handled the business side, finding new locations. His friend Don was good with tools and handled repairs. They were making $50 a week, which was a lot of money for kids back then. A year later, they sold the company for $1,200. This story is a perfect small example of the Berkshire Hathaway business model. It started with a small investment in an asset that produced cash. The cash was reinvested to buy more assets. This is the core idea of compounding. It was his first perfect snowball.
By the time he finished high school, Buffett had saved nearly $10,000. He didn't want to go to college, he wanted to get to work. But his father insisted. He went to the Wharton School of Finance but was not impressed. He thought the classes were boring and said he knew more than his professors. After 2 years, he went back home to the University of Nebraska. His real goal was to attend Harvard Business School. He was so confident he would be accepted. But the interview was a disaster. The interviewer told him, "Forget it. You're not going to Harvard." Buffett was crushed. But he later said this rejection was the luckiest thing that ever happened to me.
Back in Omaha, he was looking through college catalogs. He saw 2 names that excited him, Benjamin Graham and David Dodd. They were professors at Columbia Business School. A year earlier, Buffett had read their book, The Intelligent Investor. For a young man who loved logic, the book was a huge inspiration. It gave him a clear, rational system for investing. He immediately wrote a letter to the university. It started with, "Dear Professor Dodd, I thought you guys were dead, but now that I know you're alive and teaching at Columbia, I would really like to come." He was accepted. He chose real knowledge from his hero over the status of Harvard.
Studying under Benjamin Graham was the most important part of his education. Graham was the father of value investing. This is where Buffett's core principles were formed. The first principle is intrinsic value. Graham taught that every business has a real value, separate from its stock price. An investor's job is to figure out what the business is really worth. The second principle was the margin of safety. This was Graham's main idea. You should only buy a stock when its price is much lower than its real value. This discount protects you from mistakes and bad luck. Graham's goal was to buy a dollar for 50 cents.
The third great lesson was Graham's story of Mr. Market. He told students to imagine the stock market as a moody business partner. Every day, Mr. Market offers to buy your shares or sell you his. His price changes based on his mood. Some days he is very happy and offers a ridiculously high price. Other days he is very sad and offers to sell his shares for almost nothing. Graham's point was to never let this moody partner affect your own judgment. You should use his emotional swings to your advantage. When he is pessimistic and offers a bargain, you should buy. When he is euphoric and offers a silly price, you can sell. This system was the perfect defense against the emotions of the market.
After graduating from Columbia in 1951, Buffett wanted to work for Benjamin Graham. He offered to work for free, but Graham said no, joking that he was overvalued. Buffett returned to Omaha and worked for his father's firm for 3 years. In 1954, Graham finally offered him a job. But in 1956, Graham retired and closed his firm. At 25, Buffett decided to retire too. He had saved over $140,000. But soon, a small group of family and friends asked him to manage their money. On May 1, 1956, Buffett Partnership Limited was born. The first investment from his partners was $105,000. Buffett put in only $100 himself.
The structure of his partnerships was a brilliant way to build trust. He did not charge a fee based on the amount of money he managed. Instead, his partners first received a 6% annual return. Buffett only took a cut of the profits above that 6% return. He also put his own money at risk. If the partnership lost money, he was responsible for 25% of the losses. His fee structure was a promise: I only win if you win first. Before anyone invested, he gave them a one-page document called the Ground Rules. It said he would not try to predict the market. His goal was simply to beat the Dow Jones average over many years. This freedom from short-term pressure became one of his greatest advantages.
In 1959, he met another man from Omaha named Charlie Munger. The intellectual connection was immediate. It was the start of a partnership that would last over 60 years. Munger's influence on Buffett's thinking was enormous. It was the most important change in his investment style. Before Munger, Buffett was a pure cigar-butt investor. He looked for mediocre companies that were extremely cheap. They were like a discarded cigar but on the street with one free puff of profit left. After that one puff, he would sell and find another one.
Munger saw the problem with this cigar-butt approach. He pushed Buffett to think bigger. He said buying a fair company at a wonderful price is good. But it's hard to make a lot of money that way over time. Munger said the real key was to do the opposite. Buy a wonderful company at a fair price. Munger understood that the real magic was in owning a truly great business. A great business has a durable competitive advantage, or what they called an economic moat. This kind of business can grow and compound its value for decades. Buffett would later say Munger was the architect of the modern Berkshire Hathaway. He was just the general contractor who built Munger's vision.
In 1962, Buffett started buying shares in Berkshire Hathaway. It was a failing textile company. a classic cigar butt investment. The business was terrible, but the price was very cheap. The stock was trading for $7.50, but its assets were worth more than $10 a share. His plan was to buy the cheap stock and wait for the company to offer to buy it back at a higher price. In 1964, the CEO, Seabury Stanton, offered to buy Buffett's shares. They agreed on a price of $11.50 per share. But when the written offer came, the price was $11.375. Stanton had tried to cheat him out of a small amount of money.
Buffett was furious. It wasn't about the money, it was about the principle. In a moment of anger, he made a life-changing decision. Instead of selling his shares, he started buying more. He bought shares aggressively until he had control of the company. Then he fired the CEO, Seabury Stanton. The master of rational investing had made a purely emotional decision. He later called it his monumentally stupid decision. He was now the owner of a dying business in a terrible industry. The textile business lost money for the next 20 years. He has said this emotional mistake cost him and his partners over $200 billion in lost potential profits.
And yet, this huge mistake had an unexpected good result. His investment partnerships were temporary. Partners could always take their money out. But by taking control of Berkshire Hathaway, a public company, he accidentally got something new. He got a permanent capital vehicle. Berkshire Hathaway, the terrible business, became the perfect corporate shell. It was a permanent public company where he could put the profits from his other good investments. The capital was locked in. This allowed him to compound it forever without worrying about partners wanting their money back. The mistake born from anger ironically created the perfect structure for his life's work.
In 1967, Buffett found the perfect business to buy. It was an insurance company in Omaha called National Indemnity. This $8.6 million purchase was the most important in Berkshire's history. It introduced Buffett to the concept that would power his empire, insurance float. The idea of float is simple but powerful. Insurance companies collect premiums from customers upfront, but they pay out claims much later. In the time between, the company holds and invests that money for its own benefit. This pool of money is the float.
Buffett realized that this float was like a loan from his customers. And if he ran the insurance business well, it would be an interest-free loan. In fact, it was better. He was being paid to hold and invest other people's money. This realization was the key to everything. National Indemnity, and later Geico, gave Berkshire a growing river of low-cost cash. This float was the rocket fuel for Berkshire's growth. It grew from $19 million in 1967 to an incredible $164 billion by 2022. This ever-growing pool of money allowed him to buy whole companies like See's Candies and large stakes in Coca-Cola. This is the true secret sauce of Berkshire Hathaway.
In 1972, Charlie Munger suggested buying a company called See's Candies. It was a family-owned chocolate maker in California. Buffett was hesitant. The asking price of $25 million seemed very high. It was more than 3 times the value of the company's physical assets. This was not a cheap cigar butt. But Munger insisted. He said the company's real value was not on its balance sheet. Its most valuable asset was intangible, the space it occupied in the customer's mind. For decades, See's had built a reputation for quality.
This strong brand gave the company something very valuable: pricing power. Could raise prices every year without losing customers. Buffett famously said, "See's candies means getting kissed." He realized if people felt that way, they could raise prices. They bought the company, and it became a dream business. It was a cash-generating machine that needed very little new investment to grow. Since the $25 million purchase in 1972, See's has produced over $2 billion in earnings for Berkshire. It was the ultimate proof that Munger's philosophy was right. It taught Buffett that true value is dynamic, found in a business's ability to generate cash for a long time.
An earlier investment taught Buffett the value of staying calm when others panic. It involved a famous corporate fraud, the Great Salad Oil Scandal. In 1963, American Express found itself in a huge crisis. A client company had borrowed money against giant tanks that were supposed to be full of valuable salad oil. But the tanks were mostly full of water, with only a little oil floating on top. When the fraud was discovered, Wall Street panicked. Investors feared American Express would go bankrupt. The stock price was cut in half in just a few weeks.
While everyone was selling, Buffett was thinking. He asked a simple question. Had the scandal really damaged the company's main businesses? He went out and did his own research. He went to restaurants and hotels and talked to people. He saw that people were still using American Express credit cards and traveler's checks. The public's trust in the famous brand was still strong. The company's economic moat was intact. Realizing this, Buffett acted boldly. He invested 40% of his partnership's money into American Express stock. It was a massive contrarian bet. The bet was a huge success. The stock price recovered and he made a large profit for his partners. It was a perfect example of his famous saying, "Be fearful when others are greedy, and be greedy when others are fearful."
On Black Monday in 1987, the stock market crashed nearly 23% in one day. For Buffett, the crash was an opportunity. As others sold in panic, he calmly started buying. Between 1988 and 1994, Berkshire invested $1.3 billion to buy a huge stake in the Coca-Cola Company. To Buffett, Coca-Cola was the perfect, wonderful company. He saw its most valuable asset was not a secret formula or factories. It was real estate in the mind. The brand occupied a permanent space in the minds of billions of people. This was an economic moat that was almost impossible to defeat.
The Coca-Cola investment was incredibly successful. That first $1.3 billion investment is now worth over $25 billion. But the real genius is in the dividends. In 1994, Berkshire received $75 million in cash dividends from Coke. By 2022, that yearly cash payment had grown to $704 million. Today, Berkshire gets back more than half of its original investment cost in cash, every single year. The investment shows his mature philosophy. It combined Munger's idea of buying a wonderful business with Graham's idea of buying at a fair price, which the 1987 crash provided. His ideal holding period is forever.
While building his empire, Buffett lived a very unconventional personal life. In 1952, he married Susan Thompson. Susie was warm and social, and she helped him become more of a whole person. She was key in helping him overcome his fear of public speaking. He took a Dale Carnegie course at her suggestion. To this day, the Dale Carnegie diploma is the only one he displays in his office. In 1977, Susie moved to San Francisco to pursue her own singing career. But they never divorced and remained very close. Before she left, Susie asked a friend, Astrid Manx, to look after Warren. Soon, Astrid moved in with Warren. For decades, the three of them formed a stable and unusual family, even sending out Christmas cards signed Warren, Susie, and Astrid.
In the summer of 1991, an unlikely meeting happened. Bill Gates, the 35-year-old founder of Microsoft, was not excited to meet Buffett. He thought Buffett was just a stock picker. Buffett, then 60, was not excited either, as he knew nothing about technology. But their short meeting turned into a 10-hour conversation. They discovered they shared a deep desire to understand how the world works. Their friendship became one of the most famous in modern business history. On the surface, they seemed like total opposites. But at a deeper level, they were both master systems thinkers. Buffett built a system for compounding capital. Gates built a system for compounding information. Both were obsessed with the idea of the economic moat.
For decades, Buffett refused to invest in technology companies. He said they were outside his circle of competence. So in 2016, the world was shocked when Berkshire Hathaway started buying Apple stock. It wasn't a small investment. It grew to be worth over $150 billion. Was he breaking his own rules? Not in his mind. He explained that he had stopped seeing Apple as a tech company. He now saw it as a consumer products company, perhaps the greatest in the world. He didn't care about the microchips. He cared about the iPhone's essential place in people's lives. He saw the Apple ecosystem as the ultimate economic moat.
The Apple investment became the largest single stock in Berkshire's portfolio. It has also been his most profitable investment in dollar terms. This investment is the final result of a lifetime of learning. It has the brand loyalty he learned about from See's Candies. It is the wonderful business that Charlie Munger always talked about. His ability to finally make this investment shows that his circle of competence was always expanding. He didn't change his principles to fit Apple. He waited for decades until he finally understood how Apple fit his principles.
Warren Buffett spent the first part of his life making money. He is spending the last part of his life giving it all away. In 2006, he pledged to give away most of his fortune, then worth over $37 billion. The majority of it would go to the foundation run by his friends, Bill and Melinda Gates. It was the largest charitable gift in history at the time. In 2010, he and the Gateses created the Giving Pledge. It is a moral promise by the world's richest people to give away more than half of their wealth. Over 240 billionaires have signed the pledge.
On November 28, 2023, Charlie Munger passed away at the age of 99. His death made the question of what happens after Warren more urgent. The answer is a succession plan that has been in place for years. Greg Abel will become CEO and handle capital allocation. Ajit Jain will continue to manage the powerful insurance operations. And Buffett's son, Howard G. Buffett, will become non-executive chairman. Howard's only job will be to protect Berkshire's unique culture of trust and integrity. He is the designated cultural custodian. As of today, Warren Buffett remains chairman and CEO, but he plans to step down as CEO at the end of 2025.
In the end, how do we measure Warren Buffett's life? He offers his own way of measuring success. He asks a question: would you rather be the world's greatest lover, but have everyone think you're the worst? Or be the world's worst lover, but have everyone think you're the greatest? For Buffett, the answer is clear. What really matters is not the outer scorecard, what others think of you. What matters is the inner scorecard, the person you know you are and the principles you live by. He says true success is simple. You'll really measure your success in life by how many of the people you want to have love you actually do love you. His story is not just a lesson in getting rich. It's a lesson in living a life of purpose, integrity, and learning.